Hello, everyone who will be pouring in from the waiting room as we speak. Hello, everyone, and welcome to the December New Jersey Business and Industry Business Growth Roundtable. This is our 41st episode,
Oh my
Rachel.
God. Well, that seems like a lot.
I know,
No
I
wonder
looked
I'm
at it.
so tired.
Anyway, so we are delighted to be here. Rachel and I have been, and Rachel will tell you more about herself in a minute. We've been collaborating for quite some time now with the New Jersey Business and Industry Association to bring you this Business Growth Roundtable. It's been a great collaboration. I think we've all benefited. So let me tell you, before we get into our content, we have our annual economic outlook today, and Michelle Sakurka from NJBIA is participating in the panel. But before we get there, let me tell you a little bit about NJBIA if you don't know. How could you not? But just in case. So NJBIA is the nation's largest statewide business association, representing nearly a quarter of all employees in New Jersey, which is pretty unbelievable.
Mhm.
The NJBIA members benefit from customer development opportunities, visibility through events, magazines, TV show, podcast, and also there are a lot of money-saving discounts on things you're probably already buying for your business, such as payroll, healthcare, training, 401k solution, and 24/7 HR support. And at C3 Workplace, I don't know about you, Rachel, but we do take advantage of a lot of those because they are pooling all that buying power that they have. Now, specifically, they've got a couple things coming up that you might want to visit their website and check out. On January 15th, they are having a half-day cannabis event where they will talk all things regulatory compliance, market trends. I know many of you are involved in that budding industry, which I think we all thought would be a gold rush, and maybe it is, maybe it isn't. Anyway, that is January 15th. And then also in 2025, NJBIA will relaunch its Leadership Series program, which will be all virtual now by demand. So again, visit the website, check it out. If you're not a member, you might really want to consider that. Rachel or I would be happy to chat more with you about that. And before we get into content, a tiny bit of housekeeping. We are recording. You don't have to take copious notes. You'll get the recording. And we'll do our best to allow time for Q&A. We will ask you to use the Q&A segment of the Zoom platform because the chat gets a little wieldy. We can get some pretty big crowds on these events. And also, so put the Q&A in the Q&A section. And in January, we want to invite you to join us when we'll be talking about annual planning, new heights in the new year. I'm super excited. James Wisdom is an EOS implementer. He's going to come on. We're going to talk about planning. But what I'm really excited about is what we're doing. We've never done this before, Rachel. This might be news to you. Don't look surprised. We will run our typical program from 12 to 1. And then we will open the meeting up to everyone, and we'll have a mastermind, and we will actually address your questions, and James will stay on for extra time to help you with that. So that's super exciting. So again, I'm Donna Miller, president and founder of C3 Workplace and Donna Miller Business Growth Consulting, where for the last 30 years, we've been helping companies to accelerate their growth by providing business advisory and support services around operations, biz dev, and finance. So if you're hitting the end of the year and your bookkeeping not quite in order, you might want to talk. Our clients come to us because they know that we're going to build integrated, efficient systems that are linked together that they can execute on or we can help execute on. Basically, it's building the foundation for companies that can scale. So with that said, let me hand the event over to the fabulous Rachel Durkin, who will take it from here.
Awesome. Thank you, Donna. I'm so happy to be here. This is one of my favorite events every year because there's so much insight in this virtual room that's about to come on to predict the future for 2025. So I always find it incredibly informative. So first, I want to introduce myself. My name is Rachel Durkin. I'm with Paradigm Marketing and Design. We are a web marketing, branding, and sales enablement agency that customizes and working with clients with a complex sale. So that means if you have a sales team, if it requires a human interaction to close a deal and you have a sales team, we can build a marketing to sales infrastructure that makes that team more efficient, increases the number of qualified meetings they're having, and increase their close rate exponentially. So if you're looking to close more sales in 2025, either me or Vicky, who came on before and didn't know, like she knew what she was doing, but in most cases she does, I assure you.
And I kicked her off. No.
We would be happy to have a conversation with you. I also would be remiss this year would not be what it is without our sponsors. They are so integral to the success of this event. If anyone's ever interested in becoming a sponsor, there are a lot of benefits, opportunities for exposure, opportunities to grow your list of qualified prospects, to nurture them over time as part of that marketing and sales machine. So please reach out to Donna and I if you're interested in sponsorship for this next year. But the first sponsor I want to thank, who will also be a speaker today, and they have so much information to share. I know I have referred family to them. I have referred friends to them. They really are a huge supporter for those of us who are trying to grow our wealth and build generational wealth over time. Summit Place Financial has offered focused, individualized attention, serving a select group of highly successful people like you who have outgrown mass market institutions. Success also often brings complex investment, tax, and estate planning challenges, and Summit Place offers experienced, personalized, and disciplined guidance to help you achieve your financial goals and help simplify your wealth opportunistically. They collaborate with trusted professionals to provide a holistic, expert approach to your financial journey. And of course, Summit is SEC registered firm. They do not sell products or earn commission or have quotas to meet. They are working solely for you. Again, I have friends and family who work with them who rave about how wonderful and supportive they are. Our next sponsor, who's been our sponsor for quite a while, is Cal Thomas from Sandler Training. I'm a big fan of Sandler Training. Donna's team is Sandler trained. My whole team needs to be Sandler trained. It's part of our development process here at Paradigm. I can't say enough good things about it. I took Sandler years and years ago, when a little bit around when I started the company, my closing rate went from 40% to 70% after taking Sandler. It helps you build an infrastructure for sales. Sales kind of seems like this magic word where you're just hoping people like you to bring in revenue. There is a process around it. There is a consumer psychology science within the sales process, and Sandler Training can help you identify that. It can change your entire company culture to be a selling organization in a positive way, because profit equals possibility. I encourage you to reach out to Cal Thomas, who you'll get access to in this event, like on the chat in this event, and who will also be in the emails if you want more information about the programs that they offer. They're both online and virtual. And then last, I want to thank our supporting sponsor, Mark Shore at Atlas Consulting Services. He is an employee benefits consultant. They are a full service insurance brokerage firm with specialized expertise in sophisticated and multifaceted employee benefit programs, including health, dental, vision, life, disability, retirement, and more. ACS handles all aspects of employee sponsored benefits, from plan implementation to employee communication and enrollment, to claims resolution, to regulatory monitoring of the state and federal compliance law. As somebody who has to deal with that crap sometimes, it's really nice to have a helper.
Yeah, not something you ever want to buy direct.
Not
You
something
always need
that
a
I
good
ever want
agent.
to deal with ever again. So if you can avoid it and have a trusted partner, Mark is your guy. As a trusted partner to many of the region's most prestigious company, law firms, and hedge funds, Atlas Consulting Group as well works with large and small businesses alike, from Main Street to Wall Street. So I encourage you to reach out to Mark if you want to not ever worry about your employee financial benefits again, because I know I don't want to. So with that, I am going to pass it over to Susie, who is is that right, Donna? Am I doing this right?
Yes.
Okay.
Susie McLean.
Susie
Susie is our
McLean,
moderator.
who is our moderator for today, who will be introducing the panel. So Susie, take it away.
Thank you both so much. I love the enthusiasm. But thank you again, Rachel and Donna, for organizing just another great event, and what a nice way to wrap up the year. And I really appreciate this opportunity. I also really want to thank our speakers. I'm excited for you all to meet them and hear all that they have to share. And, we're excited to talk things about the markets, post-election planning, and what all this means to us as we begin thinking about 2025. But before we get started, I'd love to ask the speakers to turn on their videos. I'd love to kick off with asking each of them to just quickly introduce themselves. So Michelle, if you don't mind kicking us off, and then we'll go over to George, and then Liz.
Wonderful. Thank you so much to everyone who's joining us today, and to our great moderator, Susie. Looking forward to the discussion, and my fellow panelists. I'm Michelle Sakurka. I'm the president and CEO of the New Jersey Business and Industry Association. NJBIA, as you know, is your boots on the ground on all things business, putting business at the center of everything we do, from advocating tirelessly on your behalf for an affordable and regionally competitive business climate here in the state of New Jersey, which we know is excruciatingly hard. So we provide those products and services, such as some of the services you heard about earlier, 401k, access to health benefits, very robust HR and training. Looking forward to the discussion today. Thanks.
Thanks, Michelle. Go ahead, George.
My turn. Well, first of all, I'd like to thank NJBIA for inviting me. This is my first time where I've interacted with you folks, and I really do appreciate it. I'm George Hansen. I'm an investment banker, managing director with a firm called Oberon Securities. We have 80 investment bankers. We focus primarily on M&A and capital raising for business owners. In particular, we help owners who want to sell their business, raise equity financing, sell them a piece of their business. And on the financing side, we do growth financing for small growing companies, up to distress financing for companies in trouble, and everything in between. Our business is split really 50-50 between mergers and acquisitions. We have 80 bankers. We're headquartered in New York, but we have bankers in 16 states around the country, and we're growing, and that should do it.
Thanks, George. Go ahead, Liz.
Thanks, Susie. And, thank you to NJBIA and Michelle for launching this. It's a great opportunity to think big picture year end. And Donna and Rachel, thank you so much for all you do to organize this. I can't do a better introduction than Rachel did of the firm. I'm the founder and president of Summit Place Financial Advisor in Summit, New Jersey. I started the firm 15 years ago after 20 years of being a quant jock on Wall Street. And as Rachel shared, we work with pretty successful complex situations. One thing I learned from staring at a computer 20 years on Wall Street is that so many clients have a lot more they need to talk about and coordinate than just their investments. Investments are, of course, very important, but it's the walking in the door. And Susie and I and the rest of our team take a very personalized relationship with our clients and help with all aspects. Our goal is always to make sure you can sleep at night. We may always start with what's keeping you up at night. So I spend all my time on the economy. We're going to talk a lot about that today, but we're a team that's just dedicated to building very genuine relationships with our clients.
Thank you all so much. And I'm going to apologize in advance. I'm fighting a little bit of a head cold. So if you see me sipping water, it's just so that I don't have a coughing attack while we're going through this. So why don't we jump in? I want to be mindful of everyone's time. Here we are getting ready to wrap up 2024. I can't believe I'm saying that. I don't know where this year went. But we are about a month post-election. Many of us busy tying up loose ends as we get ready to end the year. The markets are impressively up 27% year to date, and there's no shortage of global events that have been keeping us all busy and on our toes. But this has many of us asking things like, what does this all mean to me as we're getting ready to approach 2025? How should we be thinking about our businesses and maybe our investments? And are there shifts we need to be making now as we get ready to start the new year? So our wonderful panel is here to talk about a lot of this and navigate these questions for you. But I'd like to kick us off thinking about the state of the economy and the markets. So given the current economic backdrop, the market's strong performance, recent interest rate cuts, a new president taking office in the new year, what are some of the challenges you're all seeing or hearing from clients are there specific sectors or industries that we should be paying close attention to? I'm going to ask Liz to kick us off on this question, and then we'll have Michelle and then George chime in as well. And I want this to be conversational. So Liz, if you don't mind maybe sharing your thoughts and some of the things we're hearing from clients.
Absolutely. You know, we started this year and the focus was entirely on inflation. Just last month, we got the latest October inflation number. For those that are numbers geeks like me, it was 0.2% month over month, which was less than the estimate of 0.3. That puts us on track for about a 2.5% run rate to inflation. Certainly on target with what we've all been talking about. Our Federal Reserve talks about this 2% long-term target. Take that as a, a range. Nobody really thinks we're going to specifically get there. As the year went on, we moved to saying, well, we're on target for inflation, but now maybe we need to worry about employment. What does employment look like? Well, this past Friday, we just got non-farm payrolls growing by 227,000 new positions. That surpassed what was expected. It greatly surpassed October. The unemployment rate inched up the tiniest bit, 4.2% from 4.1 in October. That always has to do with participation as well as the numbers. So again, getting a little geeky, those numbers all look good. Both of these things mean we're in pretty good shape. The final sort of quant thing I would look at and talk about the economy is looking at corporate margins. Margins have been remarkably stable. This is big picture of profitability. And for us, one of the early signals to say we should worry about the economy, worry about any of these indicators. With margins pretty stable, we don't see employment at risk. So we're ending the year from a position that was kind of interesting as we take that hard data, that economic outlook, and talk about what we hear from clients, what we hear from people and business owners like yourself, was we kept hearing this incredible disconnect. The conversation would go just like this. I shared all the same information. I'd say the economy looks great. That's part of the reason the market's doing well. And the person on the other side of the table would say to me, I think things suck. I think it's horrible. And we saw this in what we call the soft data, the reports that come out that are surveys, strong hard data, but yet when you talk to business owners, you talk to clients, they're not feeling how good all this data means. And we really kept thinking about this, drilling down, why such a big disconnect? And a lot of it came down to just personal pricing experiences. None of us have been in a post-inflationary environment. That was 40 years ago, where I myself was a very young child. I don't remember what it was like when mom decided not to buy Oreos because they were too expensive. I just knew there weren't Oreos in the house. We think a lot of this disconnect had to do with things like, yeah, you tell me the economy's fine, but I just paid $5 a dozen eggs for Thanksgiving. So a very specific pricing thing. Or you say the economy's fine, but I just got a new bill for my homeowner's insurance 3 times the amount from last year. That's not inflation under control. Fast forward to share with everyone here, just this morning, we got the NFIB survey. That's the National Federation of Independent Businesses. It surveys a lot of business owners like yourself. And we saw post-election this dramatic turn. The soft data surveys filled the whole gap, and hard data and soft data are right on top of each other. What that means is we're turning the corner on optimism. When I think about where we are going into the end of the year, there is more confidence that what we're seeing in the economy is going to play out through our businesses in the next 3, 6, and 9 months.
Thank you, Liz. Michelle, I'm going to have you jump in here. I know you, when we first spoke, you had some business outlook and surveys that you are in charge of. Would love to hear your thoughts.
Absolutely. So much is consistent with what Liz said, right? So our survey was completed earlier in the year, pre-election. And I can tell you, so what we do is we survey basically every year. This was the 66th annual. We ask about projections for the year forward, and then we ask people to report on how their projections for the years past actually came to fruition or not, right? And I could tell you that, the word that I take away this year was trepidation. What we really saw coming out of the survey was that people are foreseeing this lack of predictability and certainty going into the new year, and business needs predictability and certainty in order to make decisions and invest money. We see that all the time. And so, yes, we saw a pop in the market, right, when Trump was elected, for sure. But I think in a question going forward, we'll talk more about the impact of policy on Trump, right? But there's still some consternation about what a Trump administration really means. We'll go deeper into that. But let me tell you what New Jersey businesses said is mostly on their mind, right? First of all, we were asked, what are 3 things that the next governor, because we're going into a governor's election this year. We elect a new governor November of 25, and there is a big field of candidates running. And I have to tell you, we interviewed a whole bunch of them at our public policy forum last week, and I'm very encouraged by the sentiment and things I heard about what a future administration may sound like relative to business climate and business actions. But our member said, what are the top 3 things the next governor of New Jersey can do to help business climate and help me as a business owner in New Jersey? Number 1, lower my property taxes. Okay? People don't realize that New Jersey businesses pay almost 50% of the property taxes across the state of New Jersey. Now, there are some relief programs out there, like the Anchor program, which is for homeowners with a certain income eligibility, as well as renters, right? And then next year in 26, we are supposed to have, if the policy proceeds forward, the Stay New Jersey program, which is geared toward keeping seniors in New Jersey with further property tax relief. I will suggest that I'm concerned whether or not that program's viable given the future state budget, but that is a discussion for another time in the future. The challenge is any of those relief programs do not include any relief for business owners whatsoever. So business wants to be included in some of this, but more so, business wants to see reform, not just relief. Don't take my money today to give me a check back tomorrow, only if you can afford to give me the check back. We want to get the heart of reform. Number 2, health insurance comes up each and every year as one of the top costs for New Jersey business owners. New Jersey business owners want to ensure they have robust benefits so they can attract the best workforce that they possibly can. That includes good health benefits. When that cost rises each and every year, that gets more and more challenging, and businesses are caused to put more of that cost back onto the employee when they really don't want to do that, but they're getting squeezed at all ends. What was the third thing the next governor can do? They can lower the corporate business tax. Now, we've known this for years. And in fact, the corporate business tax, a surcharge that made us an outlier across the country, having our corporate business tax at 11.5%, was supposed to sunset. The 2.5% was supposed to go away December 31st of last year. And our governors and policymakers understood that a competitive corporate business tax is important to be regionally competitive, especially when our neighbor to the west, Pennsylvania, is on a trajectory to take their corporate business tax down to below 5% by 2031. But instead of honoring that sunset, which we did for literally 30 seconds, in the governor's budget, he came back and he imposed a corporate transit fee, which is the same 2.5% that is put on New Jersey corporations, our largest employers across the state of New Jersey, that employ hundreds of thousands of jobs across the state of New Jersey, right? Which again, clearly affects our regional competitiveness. So those are 3 key things. And the other thing, and then I'll stop there for now, is that we asked business, do you think that your policymakers have done enough to address business affordability for you as businesses? The answer, a resounding no. So, business is feeling left at the curb, and our next administration could do themselves a solid if they pay some really good attention to the business community and what they need.
Thank you, Michelle. George, can we touch on a little bit about the mergers and acquisitions and what you're seeing, how this impacts to your business owners, especially with interest rates dropping?
Sure. So as I gave this some thought, I've divided my initial comments here into 3 different topics. First is to talk about the lending market to businesses, because I think that that's as part of what we do is raise debt capital for businesses. Second of all, to give a sort of an overview and update of what's going on in the M&A market. And then thirdly, which is just an interesting topic, is to talk about the growing impact of private equity in in the M&A market and really to the economy. So starting off with the lending market, obviously we've seen tremendous increases in interest rates over the last 2 to 3 years. This really was created because we dropped interest rates to near historic levels. Prime rate went down to 3.25%. I think that LIBOR, which is now called SOFR, but the LIBOR is what most larger middle market companies borrow at. LIBOR dropped to almost zero. And this was an attempt by the Fed, obviously, to guard against the recession. And so then in order to cope with the inflation, they started to raise interest rates. So interest rates peaked at about 8.5% for the prime rate. I'm talking about the prime rate here because this is focused on businesses. And a lot of businesses focus on that. And just by comparison, the LIBOR rate, or the SOFR rate as it's called now, is usually about 3% cheaper than the prime rate. So the prime rate's, kind of a proxy for the two lending or interest rate methods that are used by banks. So it went up to 8.5. It's currently 7.75%. And there is trading in the forward markets, in the futures markets, and they're predicting by mid to late 2025 that they expect to see the prime rate down to 6, maybe 6.25%, but in the low sixes. Now, if you look historically, that's really about what the long-term average is. It hasn't been 3.5%, right? It hasn't. I mean, it was ridiculously low, and it was done for a specific purpose. So I don't think we should ever count on interest rates going back to where they were. And what that means for business owners is people that rely on a lot of inventory, a lot of receivables, or have a lot of receivables, and have a lot of working capital, so they've got a lot of financing, is they should not expect that we're going to see 3% prime again or 4% prime again. So they need to adjust their businesses for what is a more normalized environment. So that's kind of the overview on bank financing. But there is a interesting development that business owners need to be aware of, because it's very, very, it's a very big and fast growing segment. And that's called private credit lending. Historically, banks and commercial asset-based lenders really have been the primary of funding sources for middle market companies. But over the last decade, there's been the emergence of, basically call them private investment companies, that are dedicated to making loans to large and middle market companies. And this industry now has grown to the point where they now have about 2 trillion, I think, of assets under management, of which about 2/3 of it, or 1.3 trillion, are direct loans to businesses or private equity firms who use the money to buy businesses. So this is pretty interesting. While the interest rates are coming down, the banks over the last few years have tightened their credit standards. So the covenants are tighter, whether it's your fixed charge coverage covenant, it's your minimum tangible net worth, your debt to equity, your debt to EBITDA, or the regular ratios that any CFO on this call will understand. They've been tightening those. And so the total commercial loans aggregated for all banks in the US, and I looked this up before today, has been flat for the last 2 years. Now, when interest rates were really low, a lot of companies did jump and they did the refinancing, so they haven't had to refinance. But when they refinance now, they'll be doing it at pretty much double the rate that they. It'll be lower than an 8% prime, but it'll probably be with a 6 or 6.5% prime. So the banks really haven't been growing along with the growth in GNP. But what has come in to fill the gap are these private direct lenders, and there are literally hundreds of them. I get emails probably once a week. I'll get an email from a new private lender, and they act like private equity funds, but they don't buy companies. They just make loans, and their biggest customers are private equity firms. So this was the first year that when a private equity firm goes to buy a company, they'll basically put in 50% equity and borrow the rest. And the banks usually used to provide that funding. Almost all of it are asset-based lenders, the traditional receivables and inventory type ABL lenders. But for the first time ever, over half of the loans that were made to private equity firms to acquire companies came from these private lenders. And I have some names, you'll recognize some of the names, but you're going to laugh. Ares Management is a firm that's been in the business for 20 years, but Blackstone, which we all have heard that name, Goldman Sachs, Apollo Capital, BlackRock, AXA Investment Management, which is part of insurance companies. So you have these big institutions now that are competing with banks. Now, they charge anywhere from 2 to 5% more, but they have much more flexible structures and a lot fewer, call it hurdles and covenants. They work very, very closely with borrowers, not just private equity firms, but also middle market businesses, which they love, to structure deals that are specifically tailored to the business. And they can be much more nimble. They don't have a lot of overhead. They're not regulated by the banking regulators or the SEC, which regulates firms like mine. So they pretty much have a free hand in order to do deals. So you pay up to get money from them, but they'll probably extend credit in a more aggressively for any given company than a commercial lender would. And of course, asset-based lenders are constrained by your receivables and inventory, which they advance against. So that's kind of a new topic I thought might be of interest. And then if I talk about let's see. So now I want to move to the update of middle market M&A. Unlike what we've heard about the stock market, the U.S. M&A market has not is actually done fewer deals this year than last year. The market peaked in 2021, and it's been a downhill slide ever since. I follow middle market M&A activity, and in the middle market year to date, we've completed fewer deals in the U.S. than last year, and 2023 completed fewer deals in the middle market, and those are deals less than 500 million in enterprise value than the year before. And this, I was reading yesterday an email from, it's called M&A Magazine. It's Merger and Acquisition Magazine. Here's the title. Deal flow lays another egg in November. 2025 can't get here soon enough. So November mid-market deal activity was the lowest it's been in any month year to date. And optimists blame elections and the Thanksgiving break. The silver lining is that between aging portfolio companies owned by private equity who need to exit and falling interest rates, deal makers expect 2025 to be much better. So that's the bad news on M&A. The good news is that if you have a good company that's growing, has good margins, valuations have actually held up. And there's so much dry powder sitting on the sidelines. I think private equity has about 1.6 trillion of committed funds that they haven't spent yet. And corporations are pretty flush with cash as well, especially large corporations. So there's plenty of money out there to do deals. But what we've heard a little bit of so far in this conversation is that people have been cautious. They were afraid of risk taking because there really was kind of a lot of uncertainty about what's the future holds. But so the M&A market is in a weak position. But if you've got a good company, you're still going to get a premium valuations. Valuations for above average companies are still near record highs, and it's typically measured as purchase price divided by your EBITDA or pre-tax operating profit without including non-cash expenses such as depreciation and amortization. So, so the EBITDA multiples, which is a common term used in M&A that are being paid for companies, is actually still very, very high. The real problem in the M&A market is that if you have an average or below average company, it's very hard to sell. And that's really true in good and bad markets. But in this market, especially when people are being a little bit risk averse, a little less aggressive, what it means is that if you have a really nice company and you take them to market and you invite maybe 50 potential buyers to look at them, you'll get 20 offers. You do the same thing with a company that is, let's say, has been bumping along inconsistent profitability and hasn't been growing, and you won't get any interested buyers, or the offers they put on the table are not really done. So that's kind of a summary of the M&A market. So you got a good company.
I appreciate that, George. Well, I appreciate that perspective. I think that that's a lot of really helpful information. And I know that there's some other good thoughts you have to share for our follow-up questions. So
that was the end of my comments anyway.
Awesome. Well, that transitions us really nicely into what we want to talk about next, which is, broad market. We've got so much information, but what does this mean to all of us here today as business owners? I want to talk about, let's shift gears a little bit and focus on the business owners who are here, right? As we look ahead to 2025, what are some of the things that we should be focusing on when it comes to key issues like New Jersey policies, succession planning, and even potential tax changes? How might these factors shape the decisions that we're all making and getting ready for the new year? So Michelle, I'm going to ask that you kick us off, the impacts to New Jersey policies and legislation and what you're hearing and seeing.
Yeah, absolutely. And Shell dropped a question in the Q&A, which is really, relative to investments. So I'll leave that certainly for the other panelists. But let me start with, the impact of a Trump administration going into 2025. And I started touching on this before. Clearly, the initial market reaction was incredible. You saw the market react very kindly to the election. But looking forward, the big items to keep our eyes on, certainly on the positive side, we're hoping to see regulatory reform, obviously responsible regulatory reform at the federal level, and tax cuts continued, which is really good for business growth. Those are the things that business owners want to look at. However, where the concern and the consternation comes in is mass deportations and tariffs. And why is that? Let's start with tariffs, manufacturing industry for starters, right? We have manufacturers here in the state of New Jersey that need certain items in their supply chain or equipment that we do not make in the United States today. So we have no choice but to go overseas for those products. And those tariffs drive up the cost of acquiring those products, which in turn drives up the cost of the delivery of the product that the manufacturer is producing. So we have to sit tight for it right now and understand how how the policy is going to proceed. Will it be a scalpel? Will there be exception? How will we be able to influence that on behalf of certain industry and businesses? But that is something that we need to be mindful of. The second on mass deportation is that we're the most diverse state in the nation, right? And Shell hit right on it with agriculture for starters, right? We have a lot of immigrants, and whether illegal or otherwise, we're a diverse state. We have a lot of immigrants that do service the agricultural industry here in the state of New Jersey. And frankly and transparently, we have a lot of jobs, not just in New Jersey, but across the country that Americans don't choose to do anymore. And this is where our immigrant population steps in. And we want to be very careful to ensure that we're not, pulverizing certain industries when we talk about mass deportation. The other thing on the whole other end of the spectrum here is HB1 visa workers. And certainly that's a process, right? So I certainly don't believe that Trump, when he talks about mass deportation, is talking about people who are here under a particular process. I think we know that to be the case. However, when you open this door on mass deportation and a slippery slope begins, we have to watch, because those HB1 visa workers, they're significant to our large companies, right? Our pharma, engineering, technology, and the students who came here and were accepted to our higher ed institutions, to our future workforce. We want the benefit of the education that they received, to keep them here. So how's that going to translate back to New Jersey policy? It could really go one of two ways. Number one, some could get very nervous and say New Jersey, as what we have been over the last some years, albeit this election gives us pause on whether we're a very blue state or are we moving more to the middle, which I would suggest we are. I think we're moving back to a moderate purple state as opposed to that very leaning blue state that we were at the beginning of the Murphy administration. But keeping in mind that history of that blue state, is New Jersey going to want to, prove a point and try to have an anti-Trump agenda where they're going to get ahead and say, well, maybe you're going to do that there, but where we can set policy in New Jersey, we're going to continue to do it in a more progressive manner. We need to keep our eye on that. Why I'm not so concerned about that here in New Jersey is next year's an election year. And as I said, we have a gubernatorial election as well as an assembly election. And those in the legislature in particular, and those policymakers understand that people are voting with their hand on their wallet, and the issues, kitchen table issues of affordability in the economy are leading right now. We heard that 4 years ago when Governor Murphy nearly lost the election when Jack Ciattarelli ran. It was a very close margin. And our legislature woke up the next day and said, oh, we have to listen to tabletop issues and affordability, and we will address it. But 4 years went by, and here we are, which what I would say is still a very challenging environment for affordability in the state of New Jersey. So now they heard it a second time, and now it is important that they keep the issues of affordability at the forefront as they enter any policy going into 2025.
Thank you, Michelle. George, following up to that, can you share a little bit about what exit and succession planning you're discussing with your business owners?
Sure. Let me just get my notes here. Succession planning is a big subject, and I'm sure Liz could spend an hour on this as well, and maybe she will be following me. But succession planning is oftentimes defined as passing the business on to the next generation. What I'm going to speak about is really exit planning, which is what do you do if you own a business and you're not going to pass on to your children? How do you get the most value from the business that you've created or lived with or built over the last 20 years by selling it to someone else? So exit planning and succession planning are very, very similar in many ways, but they're very different in others. So in exit planning, I've put some bullet points here. The first thing you should do is hire good, experienced advisors in legal, tax and accounting, and an M&A advisor to help you steer and navigate the process. I think that if you don't have good advisors up front, you're really going to, first of all, you're going to pay a lot more taxes, but you're also going to sub-optimize the wealth that you create and the comfort you can live in for the rest of your life. Confidentiality is a key issue both internally and externally. So when you start talking about this, I wouldn't share it with people in the company, and you certainly wouldn't want to make any sort of firm decisions that you're looking to sell your business and articulate those to any outside advisors who might leak it. So you need to be very careful who you talk to. So typically you talk to your wealth manager, you talk to your corporate attorney, you might talk to your tax accountant. I wouldn't recommend talking to your commercial lender. And internally, maybe you would bring your CFO in or someone, but confidentiality is very, very important because you don't want employee turmoil, and you certainly don't want competitors whispering in customers' ears that there's a big change in your company. As I mentioned, you got to take care of your estate planning, and I think that's key. Now, when you're thinking about how you want to go about selling your business, do you want to sell all of it or just part of it? In other words, you're going to retire, or do you just want to take some chips off the table? That'll point you in different directions on who will be interested and how you should approach them. Are you just focused on maximizing the price, or are there other factors that are important? Personal or family matters, financial, employees, legacies that you want to leave, the community. You might take an offer that's somewhat lower because the buyer is going to keep the company intact, but you had a higher offer from someone else who was going to consolidate it into their business, and there'd be a lot of job losses. And if you want to just take some chips off the table, maybe you want to bring in some capital to do an acquisition, maybe you want to just diversify your wealth, then you're probably looking at private equity, because corporate buyers buy 100%. Private equity firms like owners to roll their equity, and the longer they stay with a company, the more most private equity firms like it. So that's an important consideration. What I like to say is you only have one chance to make a first impression. So if you ever get approached by a potential buyer, I would hold off and say, I'll get back to you after I've thought about it and talked to my advisors. Because the first meeting you have with the potential buyer is the start of the negotiation. And certainly don't share any financial information or sign NDAs or do anything of that sort until you've taken the time to talk to people who are experienced in transactions. And another point I'll make is as you're running your business and you're planning to exit, you should probably not make any major investments that you won't get payback on in the near future, because buyers won't give you value for that if they haven't shown up in your historical financial statements. So you need to be careful on what decisions you make. I sold a business a few years ago that implemented a big ERP system, and it actually was a failed implementation, and that was about the time they were trying to sell the business. So this big project that they launched actually hurt the valuation of the business. So you need to be very careful on that. Let's see, and do not go to a valuation company to do a valuation of your business for selling purposes. These valuation firms have methodologies which are not consistent with the way buyers look and value businesses. So make sure if you're going to talk valuation, go to someone like me, an investment banking firm that sells businesses for a living and really understands how the market will value your company, not someone who doesn't do M&A. That's very, very important. I can't tell you the number of times a business owner has waived the valuation report in front of me, and it just made absolutely no sense. They are valuable for estate purposes and other purposes, but they're not very reliable when you're really looking for. You need to talk to someone who really understands, different industries, different valuations, what the trends are, and so on and so forth. And my final comment is don't do anything until you're fully committed. Once you decide you want to exit, it starts to get expensive, and the process to sell a business can take 6 to 12 months, and it requires a lot of help from outside parties as well as probably some inside parties in the company. And then my final comment is please hire an investment banker. The last survey I saw said that 100% of business owners valued the services of the investment banker, and most small businesses don't use investment bankers, but would you sell your house to the first one that knocks on the door? I don't think so. What you need to do for 90% of companies is have a competitive process whereby you're sharing information with people and getting multiple bids in, and then you can work the bids and really maintain the negotiating leverage you need to maximize value.
Thank you, George. I appreciate that. Sticking with planning, Liz, can you talk a little bit about the potential tax changes that we're seeing heading into 2025, and what maybe some of the planning opportunities might be that we want to keep in mind?
Sure. Let me start from the individual up. We talked about policy. I think it's tax and it's other policies too, as Michelle shared. Certainly a lot of focus on immigration policies that are going to affect your P&L in a number of ways. So if we start with the discussion of you as a business owner and an individual investor with your own P&L, there's certainly still some year-end tax planning you want to think about doing. It's been a great year in the market, but you do want to review, is your portfolio well diversified? Have you taken on too much weight in that NVIDIA stock? Do you have room to take some capital gains? Now, the top capital gains right now is 20% plus the 2.3% Medicare. That might be under pressure next year. I think we all think that the first attempt in the new year is going to be to carry forward the last tax act that sunsets on 12/31/2025. They'll try to move the whole thing forward, but given where the deficit is and the additional spending that the new administration wants to focus on, there very well may be some tax compromises, and an easy one in some ways is capital gains tax. We could easily see it go back to 28%, which was the tax for many, many years. That's a big boost from the current top rate at 20%. So you may want to take some personal capital gains this year. If you have some losses to balance those off, by all means do that, but be thinking about it. If they do change the tax rates next year, remember, those aren't going to take effect until 1/1/26. So you do have some time to do some of this next year as well. But this is certainly a good time to review your own portfolio for that as well. If you have some retirement plans, particularly individual ones, like an IRA, a backdoor Roth, or a Roth, we help a lot of successful clients set up backdoor Roth IRAs to keep building tax-free money. You usually have till tax day to fund those, so you still have a few months, but start thinking about this. An important one I like to point out now that we move from your individual to you as a business owner is if you don't have a retirement plan for your employees and yourself, think about an individual 401k. This is a great plan that allows you to contribute to it before year end as an employee, calling yourself an employee, and then before tax day as the employer. It's an opportunity to put a lot more money into your retirement than you can with an IRA plan. But one of the hitches is you do have to establish an I-401k or an individual 401k before year end, before the calendar year end. So this is something you need to think about, talk to your advisor about in the next few weeks. Accountants really will talk to you about a SEP IRA because it's very easy for them to help you with that by tax day, but you can put a whole lot more money aside with an individual 401k. So, talk to your advisors about that and look into opening that before year end. Now, if we go up to the thoroughly business level, taking on a little bit from when George was talking, if you are trying to think about possibilities in 2025, exiting, merging, partnering, then we want to talk to you for tax purposes about a couple things. We want to help you think through your corporate structure, your titling. There's a lot of different ways we can take some of that ownership and put it into trusts or certain structures that will make any future transaction a lot more tax efficient. And we do a lot of that for our clients. So you want to do that early before you go to the investment bankers, so that you're positioned best for an efficient transfer to family owners or outside owners. And that, again, is something you kind of want to be thinking about if we see a change to the estate tax limit next year. That's another thing that certainly feels like it might be on the table in 2025. And business owners in particular are the ones who get hit by that because you may have a sense of value for your company. You may be up to date, you may not. You go to think about a transition, and the value of that company might surprisingly push you and your family beyond the lifetime estate tax exemption. So we want to be doing planning for that going into 2025 again before we see some of these changes in the tax code. The last thing I would just really comment on, because Michelle didn't quite comment on it, and it is very specific to us in New Jersey. I know we're all looking at it, is there's not much we can do about it, but we're certainly all hoping that in any updates, that SALT limit will be changed. And that will be a huge benefit to everyone in New Jersey in particular. And we'll be able to do more tax planning with our clients, and you will with your business and personally, if we can see that change come through next year. So everyone will be lobbying for that.
Thank you, Liz. Just being mindful of time, I want to wrap this up on a high note for everyone. And I really, really appreciate all the helpful information you all have shared with us here today. As we prepare to end 2024, what is one actionable step or key piece of advice that you would each suggest to our listeners here today as they prepare for the new year? Liz, since you're just wrapping up, do you mind kicking us off? And, just on a quick 1 minute response, what are your thoughts?
Absolutely. We've had 2 incredible years in the market, and I think that this is exactly the time to be reviewing your retirement accounts and your personal investment accounts and rebalancing that risk profile. We don't know what next year brings. The odds historically are that it's a moderate return year in the markets, but you really want to be taking advantage of the growth we've had and reassess the risk and make sure you're fully diversified in a way that best fits your own risk profile.
Awesome. Michelle, how about you?
Well, I would say stay close to NJBIA with all the policy that's going to be swirling around over the next couple of years, right? You're the boots on the ground. We look to you for what are going to be the consequences of policy so that we can stay 2 steps ahead. So I'm going to drop the website as well as my email in the chat for everybody. Please reach out and see how we could be helpful. But stay tight, get on our mailing list, and understand, be informed about what's going on. You're all very busy. We're out there trying to keep an eye on the issues that will impact you each and every day. Let us do our job, but the best way we do it is by ensuring that we stay close to you and you stay close to us. Thanks.
Thanks, Michelle. And George?
I have something I've been thinking about, and I think every business needs to do a strategic plan. That's too much to ask. I think what every business owner should do, though, and could do pretty easily, is to have a planning session with all of their key executives and sit down and do a simple SWOT analysis. What are your strengths and weaknesses and opportunities and threats? And then during that session, think about what you can do better. Maybe you should prioritize certain things differently, but use that as a way to really sharpen your focus on how you're going to improve your business. And again, consider doing even a more rigorous strategic plan with a strategic planning consultant.
Awesome. Thank you so much. I want to thank our panelists for sharing so much valuable insights. I hope you all found this to be helpful today. And as you can see after our discussion today, it's clear that thoughtful planning, adaptability, and staying informed is so critical. I hope you're walking away with some ideas that you can apply to your businesses and investments. But here's to a wonderful holiday season to everyone. And Donna, I'm going to turn it to you. I'm sorry we ran out of time, but if our panelists can drop their contact information in the chat box, that would be great. And we welcome, feel free to reach out to any one of us with questions that you might have.
Thank you all very much. I have 3 pages of notes, and I love that you boiled it down to, what are the action items, and, rebalance your risk, stay informed by staying close to NJBIA. And Michelle, I can't thank you enough for what you do, because with this election, I have to say I was in news overload. So I tend to stop, which, finding the middle ground can be difficult. So I thank you and NJBIA for the role you play in that. And, George, I couldn't agree more. Strategic planning is so important. Or planning, just plan, just write it down, plan. And we will be talking about that in January. So I want to thank each of you for your participation. And I will say, as you all were talking, I was thinking about a few different things, but I've been reading a book. It's called The Storm Before the Calm by George Fried. But what it also talks about, which I think layers on top of all of this, is apparently as a country, we have a couple of major cycles that happen over long periods of time, 50, 60, 80 years. Things that, like the Depression, changes the country, and it's an institutional cycle and it's a socioeconomic cycle. And what's also happening in this decade is that those 2 cycles are overlapping for the first time ever. So combine that with this just new political, economic climate, and it can be a little daunting. So again, I can't agree more. Stay strategic, stay focused, stay informed. So thank you all so much for joining us. Thank you to our panelists. And I want to echo Susie's sentiment, wishing you and all of yours a blessed holiday season. And we'll follow up with email, and you can follow up with us with any questions we didn't get to. So thank you all very much. Until January, we hope you enjoy your holiday season. Bye, everyone.